That's what we're looking for out of our growth. With a gain last year of about 35%, if you had $100,000 in this, you would have made $35,000 in passive income. That's $3,000 a month for doing nothing. Owning a high growth stock in a sea of regular stocks is kind of like being a high school football player but being 7 feet tall and over 400 pounds. But anyway, today is going to be a very fun video because I'm going to give you guys not only 7 of my favorite growth stocks that I'm looking at, but also all of these are on sale. For those of you that are new to the channel, welcome. My name's Nolan, or Professor G as my students call me. I'm a professor and I specialize in personal finance. On this channel, I do all the research so you don't have to, and I make it my mission to simplify all the craziness going on in the financial world, especially in the world of investing. So let's get right to it with these growth stocks. So businesses that are in the growth category are ones that grow faster than normal. And so if you invest in the right ones, that means that your investment will grow faster than normal as well. So first on my list is Salesforce, or CRM. Salesforce is one of the world's largest software as a service, or SaaS companies. Salesforce wisely has built a platform in recent years, adding communications and e-commerce functions on top of its core marketing management business. Now looking at the charts, Salesforce is super down. Right now it's trading at about $187. If we look at the 52-week range, that is very much at the low end of the past year. It still has a crazy high PE ratio of 126, which is normal for growth companies. They're going to have a very high PE ratio. When you're looking at growth stocks and you're thinking if you should invest in them, you want to look at the competitive advantage. You want to understand if there's other companies that can come in and do exactly what this company's doing. The sheer amount of accounts that Salesforce has and the fact that it's just kind of a household name in corporations as far as CRMs go, to me, the stock is super undervalued, and with the growth potential that can happen on top of that, this makes this one a good one for me to invest in. The next one on my list is Shopify, and this one is a doozy. I really like this stock for the long term as it continues to alter the e-commerce landscape. Shopify is building out an impressive platform for online sellers, covering everything from website building to shipping solutions. Now, as a professor, one of my subjects is entrepreneurship, and in every single one of my class, hundreds of students, they're all starting businesses, and most of them are starting them online. A lot of them talk about Shopify in their presentations because it's just such an easy platform, and it makes it so that the entrepreneur has a package ready to go and can start selling today. Looking at the charts, we are down 12%, which definitely makes sense, especially with Netflix being down. A lot of these types of stocks are down today because of that and the overhype. We're at $530, which is much, much lower than where we've been in the last year, so super on sale. The PE ratio on this one is 23, which is very crazy for a growth stock. This is more in the value stock range almost. And again, looking at this chart here, we just see that it is very much on sale. And so you have to ask yourself, is this stock doing bad? Is this company just losing market share and they're going out of business? Or is this possibly an overreaction to what's happening in the market? And is it something that they can recover from? And even more than recover from, can they excel? I think Shopify is one of the ones that will excel in the future, but for now, everyone's a little bit scared, and that's okay with me. The other thing with Shopify that they're doing is they are doing a stock split 10 for 1 soon. And so right now the stock is at about $530. With that stock split, it's going to bring it down to $53. And so more retail investors, and especially younger retail investors, will be able to buy a full share. Since that is a lot of who is actually using the platform, they may want to invest in the company that they're using. I think that's going to be a very attractive reason why this stock might grow in the future as well. Analysts expect 31% revenue growth this year, 33% growth in 2023, and 37% growth in 2024. Accelerating growth is definitely on the horizon if Shopify can deliver. Next, you knew we had to talk about it because it's all over the media right now, and that one is Netflix. Netflix is getting crushed in the market right now. But do you think that Netflix is a bad company and that they're going out of business? Who do you know that doesn't have a Netflix account? Netflix is just flat out worth more than what they're selling at today. Still the #1 streaming platform, and it's still the one that everyone has and will continue to have moving forward, even with the rise of competitors like Disney Plus and Apple TV. Now, an earning report just came out for Netflix, and it was much lower than what people had projected in many different metrics, specifically subscriber growth. There was actually a negative growth, which means that they lost subscribers for the first time in a long time. You have to know that that does make sense for where we're at right now. That's why it doesn't worry me. A bunch of people bought into the service during the COVID era because they were at home and that's all they could do. Now people are going back to work, and with high inflation costs, they're just cutting out certain things for the time being. But eventually they're going to come back to the thing that's always been there, and that's going to be Netflix. Netflix today is at $222. As we can see in the 52-week range, it was up all the way at $700. So we are very, very low year to date. We have really dropped. It's down 36% as of today because the market is just overreacting right now. The PE ratio for now is at 19, almost 20, which again is so low for a growth stock. This is almost value territory, so I really like it for that specific reason. Here's the reason I'm betting big on Netflix right now. A couple of months ago, people were very happy spending about $700 a share for this streaming service. This is still a profitable company, and it's one that is still the market leader and #1 for streaming. They still make original content, and they're investing heavily in their own platform. Warren Buffett says, when everyone else is greedy, be fearful, and when others are fearful, be greedy. Well, everyone is showing that they're fearful on this, and so this puts it in a very attractive range. The next one on my list is Adobe. Adobe's been around for a long time. It's a household name just like some of these other ones. It's one that's continuing to innovate, and it's continuing to grow. In 2017, it generated $7.3 billion in revenue, and analysts are now seeing it pull in roughly $17.9 billion for 2022. In addition to Photoshop and Illustrator, the company has assembled a wide array of other pieces of key software. Some, like Acrobat, have served as a launching point for a broader cloud-based app ecosystem. The thing that I really like about Adobe is that they have smart people running this company, and they're looking for acquisitions. Adobe today is at about $430. It's down only about 1.5%. The PE ratio is still pretty high, 42. But again, growth stocks were used to being over 100. It is down in the lower range of where it's been in the last 52 weeks. So again, another stock that's beaten down by the market a little bit and so on sale. Adobe is one that has a lot of big things coming in the future, and they're just poised in the right place to be positioned for solid growth. Number 5 is a company called Twilio. This company is forecast to grow revenue between 30 and 35% in each of the next 3 years. Next year specifically, Twilio is supposed to flip profitability. With top customers including Stripe, Airbnb, Salesforce, and others, I expect Twilio to hit new highs. Communication with customers is key for any business, giving Twilio an exceptional moat. Their whole business runs on the fact that businesses need to communicate with customers. And so specifically Airbnb, a host can now communicate with somebody trying to come in and rent the house, and they can communicate with them in a non-archaic way. It could be a text message, or it can be an email, or it can be whatever works best in an integrated system. That's all seamless, and it's easy for both parties to use. Twilio is another company that's beaten down super bad. This one's very much on sale. I would place this a little bit further in the risk category, but with high risk comes high reward. Twilio is trading at $131 or so. It is down almost 10% for today because, like everything else that I've mentioned in this video so far, Netflix kind of pulled everything down. As we can see in the 52-week range, we are very much at the low end of the 52-week, which again is a very nice place to be trying these companies out. And as we can see down here, Goldman Sachs is still bullish on Twilio despite the price cut. It's companies like Twilio that come out of nowhere and people make 3 times, 5 times, 10 times their money because they were able to see something that other people weren't able to. As far as growth stocks go, individual stocks is going to give you that super high risk and hopefully high reward, but something that can help mitigate that risk just a little bit while still giving you a pretty high reward is to go with a high growth ETF. So my last 2 picks are both gonna be ETFs. Of course I'm gonna put some ETFs in this. You had to know that I was gonna have at least one ETF in my picks. So the first one is the Invesco S&P 500 GARP ETF, SPGP. This ETF is selling at $92. It's one of the only ones that's up today, 1%. It has an expense ratio of 0.36, which is actually pretty low for a growth ETF. The price to earning ratio is 18, so that's very, very low, especially for a growth ETF again. It's all stocks, no bonds. The highest sector weightings in this are healthcare, financial services, and technology, and these are the top 10 holdings. Overall, this year it's down 7%, so this is not a bad time to be buying this. The 3-year return is at 20%, which is very, very high. As we can see, the annual percentage each year has been pretty crazy. There's been a couple low ones where it only went up about 2%. It barely went down, but most of the time it's double digits, especially lately, high 30% gains. That's what we're looking for out of our growth ETF. With a gain last year of about 35%, if you had $100,000 in this ETF, you would have made $35,000 in passive income. That's $3,000 a month for doing nothing. The next growth ETF is the Vanguard Mega Cap Growth ETF, MGK. This one is selling at about $222. It is down about 1% today. The expense ratio for this one is 0.06, which is very, very low and is typical of Vanguard, which they always have very low expense ratio. The holdings for this, their price to earnings ratio is a little bit higher, but again, for the growth sector, that's kind of normal. They're almost 100% stocks, and their highest sector weightings are consumer cyclical, communication services, and very high in technology. Top 10 holdings look like this: Apple, Microsoft, Amazon, all companies that you probably want to be holding. And as far as performance, they're down 15%, like I said earlier. Their 3-year is at 20%, very high returns per year. I like looking at history, even though it doesn't mean that that's necessarily what's going to happen in the future. It is just good to see the trends and to look at charts in that way. So whether you pick growth stocks or dividend, and whether you do individual companies or ETFs, just make sure that you do your research. Use videos like this as a starting point for you to do more research. Now that's all I got for you today. Professor G, out.